All right, what's going on, everybody? We're halfway through the week. So we had a topic request about the spot gamma stuff that gets posted every day, and it's a good one to focus on. That's why I share it every day. One of the things about spot gamma, like most of those places, is the idea that they need to explain themselves, even if you don't have an account there, so that you will want to have an account there. Hold on, somebody's stuck. Gotta get them pointed in the right direction. And so these places, Spot Gamma, Volland, Menthor Q, Trady Ticks, they all have these public pages that you can use to get a better idea of the services they have to offer. So right now I'm on the Spot Gamma's website and you can see I'm not logged in, right? It's asking me to log in. So even if you don't have an account there, if you wanted to learn about call walls and put walls and the different combos, hedge and zero gamma, all of that stuff, this is their glossary center. If we just look at the menu that I went through, from the support center, I went to the glossary, and then from the glossary, I looked for spot gamma key levels, and then from there, I'm at the call wall. So you could use this process, you could use this website, and you can go through all of those different options levels. On the right hand side are other levels. We're looking at the call wall, and it says, well, if you're going to look at the call wall, you should probably look at all of these levels too. And so once I was done with this article, I could just click on the put wall there for an example and read about the put wall or large gamma strikes, whatever it is, right? And whatever you start to type in, it's going to offer you suggestions for things. So if you're reading about stuff and it starts to mention something you've never heard about, then you can copy and paste that into the chat as well. And that'll give you another article to read. So it's a really good resource. I'm going to go back to the glossary page, which is just this section here. And then I'm going to post that in the chat so that you guys can help yourselves to it, right? There's no reason for you to only have what I shared today in the chat. You should have access to that so that you can peruse it at your leisure. So let's go back to the call wall. They do have a write up about what it is, which really helps, right? It's a good starting point. And then some history on it, how, for an example, the call wall has provided resistance 83% of the time, and about what has happened in the past if we actually break through the call wall, which I believe was part of the question from this morning about, hey, what are we supposed to do with these walls? Uh, Now, what they don't mention in the article, as far as I know, is how to interpret a roll up or a roll down. And that kind of goes back to what I shared this morning, because I look every morning, as you guys should. Are the call walls and the put walls in the same place that they were yesterday? And if not, what happened? Did they roll up? Did they roll down? Because then you got a better idea of what's going on. Right. So every day when I come in, I post this picture and it has those levels on it. Now, it doesn't have yesterday's levels, right? So, what I recommend is if you don't have a Spot Gamma account, save this image, and that way tomorrow when I come in and I post the image, you can compare the new image with the old image and see, are the levels different? or just draw the lines on the chart. When I come in the next day and I post a new image and you go to draw the lines again, if the lines are in the same spot, they didn't change, right? It's pretty easy. So I noticed today that they were different. And since I have access to Spot Gamma, I pulled this tool up and I measured or asked it to show me, what did it look like? And this is the the new position. This is where we're at now. So when we look at the question on, well, what does this mean and how should we interpret it? Since price isn't in this image, it's hard to kind of tell, what has happened in the past when we get these calls and put walls getting rolled up or rolled down. But the main takeaway, as I kind of touched on in the morning briefing, is that this is just one bit of information, and by itself, we wouldn't do a lot with it. It is bullish for the put wall to be rolled up, right? That's a bit of a bullish bias or a bit of a bullish behavior, but that wouldn't make me go long all by itself. And the same thing with the call wall. If we see the call wall rolled up, I would interpret that as a bullish bias or a bullish activity. But again, that's not enough for me to do anything. Well, I'm not going to go, jump into a trade just because of that. And sometimes they cancel each other out. The put wall may get rolled down, which would be bearish, while at the same time the call wall gets rolled up, which would be bullish. And those scenarios can happen at the same time in the same day. So that doesn't really help us out. So we just want to look at where they're at, find out if they got there today or not to have a better idea of how long has it been there? Has it built up a lot of structure there? Maybe even turn on different tools like the TPO profile or the volume profile and see if we've built anything up along those levels and see how it interacts with other things like gamma and zero gamma volatility trigger, which all of those you can search for here too, right? So the short end of the stick is when we have a call wall and price hits it, it's where we expect them to monetize their calls. And think about that for a minute. If they're long calls and we hit that spot and they start selling calls, well, they're selling calls. It should very likely pause price, make it stop and or begin to fall a little bit because we're getting selling pressure. Doesn't mean it's going to, reject as a resistance level and we're going to come crashing and burning back down. It's just where we would expect them to monetize the calls. And we would have a hard time continuing to push higher above that. So while it's possible we can push higher above it, there's no guarantee that we're going to, right? Or that we'll get very far, even if we do get above it. Same thing with the put wall. As we fall down into a put wall, we would expect them to monetize the puts, and that should stop price from falling, at least in the short term. So they go into it. I think they did a really good job, and it's worth a read. Then they've got the video down here. That helps too. So when it comes to all of those tools, Spot Gamma, Tradie Voland, all those guys, they have public pages for a reason. They want you to see this stuff because they want you to buy their product, right? So they know you won't do that if you don't understand it. And that's why they offer it. They also have YouTube pages. So if you go to YouTube and you type in Spot Gamma call wall, you're going to find videos on that and put wall and all of those because they want you to understand their product because they want your money, right? Now, I post exactly, that's all it is. They're just trying to sell it to you. Now I post the stuff so you don't have to buy any of it. It's all good. Just take a look around. You'd be surprised at how much information is out there that you can use, and it doesn't cost you anything. It's I've been spending the last few days doing these write-ups for the new trader series, and that's what a lot of it is just pointing out, where resources are, because I hear from traders all the time that say, you know, everything is so expensive when it comes to trading. And sure, I mean, if you want it to be, the tools are wild. You can spend thousands of dollars a month on tools. And that still doesn't guarantee you're going to be successful in trading either. That just means you've got a lot of overhead. You're spending a lot of money. But when it comes to education, really, you don't need to spend as much as you would think. So that's just one of those. This is their blog, which, sometimes they have some pretty good write ups. There's another company called Trader Volatility, and they have, like, a boot camp course on dealer hedging and dealer hedging dynamics, and better understanding the entire process. So take a look around. You'd be surprised, and don't go buying a bunch of stuff. I guarantee you, just because it has some big fancy price tag on it does not make it better, or that it's going to give you better results, turn you into some amazing ninja trader, because it just doesn't work that way. Yeah. Yeah, get it for a month, and if you do like it, then consider the yearly. All right. Now I shop around and I find tools sometimes that are just getting out there, just getting started, like Edgeful. Now Edgeful's been around for a while now, but when I found it, it wasn't really all that popular. Not very many people had heard of it, and I got a really good deal on this, and I got locked in at a great rate. So I'm grandfathered in, which is nice if you can get it, but what I pay is nothing compared to what you guys pay, or for anybody who wanted to go get it now, for an example, I should say. I haven't been over here for a few days, and if they change the structure of the website, then it can't find where you were. So this it's a really cool place. It's like a statistics buffet. They've got just about anything you could ask for, and if they don't have it, you can ask for it, which I really like. I can't tell you how much I appreciate the fact that they will listen to you when you make requests. So if you've come across something on Facebook or Twitter, X, whatever you want to call it, and it's kind of new, shop around and see what you can find. Be amazed at some of the resources that you can get your hands on. And this is just one example, but I've got tools, products, services that, I locked in a really good price, and now I don't have to pay out the nose for it. So hopefully that covers the how to read the call wall and the put wall. Now, the other part was, if I say, or if somebody says the puts rolled up, what does that actually mean? So it was it was overlaid on the ES, but we really want to talk about options from an SPX standpoint. The reason I don't in the mornings at 7:30 is because the SPX isn't open at 7:30 in the morning, right? So we just use the ES. But now that the market's open, let's just use the SPX, right? So we go in and look at the SPX, and we've got this level where there's the greatest amount of puts on a particular expiration. So we'll say that it's the monthly options expiration July 18th. And we would look at the puts, and wherever's the greatest amount of open interest, that's not exactly how they get the put wall, but let's just keep it simple. It's at 6,000, and we'd say, oh, well, the put wall is at 6,000. If that gets, quote, rolled up, how did that happen? Well, they would close those options at that strike, and they would open a new options location at a new strike, right? It'd be the greatest amount of open interest at that new strike. Now, they don't use open interest on Spot Gamma. They're more sophisticated than that. But if you're at one of those generic companies that are just, running it like really cheap, that's exactly how they'll do it. They'll just look at the open interest. At Spot Gamma, they're using notional value. So they're calculating, the expiration, or excuse me, the strike versus the open interest, and they run the notional value of what those options are worth. And that's a part of how they get their put wall or their call wall. But it'd be the same idea, right? The reason that that becomes important is sometimes they don't roll the call wall. Remember, it's a machine, right? So the machine is looking at what the notional value is every night, and then it gives them the level, and they do their little write up the next day. Well, the notional value can change just because that strike got closer to the money. So then options didn't get traded necessarily. They were the same trades that were already there, but the put wall moved because that strike got closer to the money, and that notional value increased to a greater level than another location was before. Hopefully, that's not too confusing. The whole point, though, is it's just an options process. When we roll an options trade, that means that we closed the current trade and we opened another one somewhere else. Now, if you're thinking, why don't you just say that you closed the trade and opened it somewhere else? Because if you do it manually, you have to fight the bid and the ask to get it closed. And then you have to pick your new spot and fight the bid and the ask to get it opened again. And then eventually you're going to close that one, and you'll have to fight the bid and the ask to get it closed at that point. Well, that's three different fights in the bid and the ask. If you do it as a quote roll process, you click the button that literally says roll, and it will help you avoid fighting that bid and the ask to get out and then back in. You'll only have to fight it once during the roll. So you get to eliminate one of the bid ask spread fights. That can save you hundreds or thousands of dollars depending on what product you're trading. Slippage is real, bro, and it hurts. If you're trading in the futures, I'm not going to say that options are not going to help you at all. Um, but if you're trading in the futures, your focus on options should mostly be limited to dealer mechanics. The day-to-day Joe Schmo options trading shouldn't really be something you have to dig too deep into right away. You can put it on the back burner and just learn it later. It's still useful to have by all means. Anything that you learn about trading will help you trade anything else better. So earlier today, I was talking with somebody, and we were doing in the money SPX call credit spreads, but it was kind of expensive, and so they went with the XSP call credit spread. It was like a German style trade, and I believe they got their position on with 606, 608. I went with 605, 608 for my choice, but they wanted this, and they were getting it filled. Really, it was about the same price as it is now. I think their risk was 16 cents when it was all said and done. So they've made $4 so far after all of that move. But this is going to expire today, and as time goes by, depending on where we end up closing, what's the break even on this thing? 607.82. Yeah, I don't think we're going to make it now. Um, but theirs was priced differently. See, 16 cents, they would have been right there. So their break even would be 607.84. Nah, I just don't think we're going to get there. It's like another 90 cents. We could do it, right? But yesterday's halfback is holding. So unless that breaks, it's not going to happen. Did get a QQQ trade on, and I put that one in the trade channel. So we've got this butterfly. It's a really cheap butterfly too. It's only $26. Using the 515 strike. It's 7 strikes wide. So risking $25 for a chance to make 700, well, $675. Of course, we don't get max on those, right? So if I can get 25% of $600, I'm okay with that. It's not bad. And then I added an AMD put butterfly spread as well. That's $4 wide, and I filled that one for $22. So really cheap, low risk stuff, and that's because I have no interest in putting a lot of risk on in the current market backdrop. This is a market just looking for a reason to go higher or lower, and there's no technical bias for either. So like no big picture pattern or setup or signal, and we're getting really close to window dressing. If you haven't heard that phrase before, just scroll up in the chat. I put in a little summary of what that means because I knew we'd be mentioning it. We don't have any stock buybacks because we're in the blackout period. Powell just made it through. You know what could spark us though is the House and the Senate. We've heard that over the next few days, which means probably before Friday's close, that the House that the bill that made it through the House and was in the Senate may get finished up. The trick is the Senate going to make any changes and kick it back to the House again, or is it going to be done? We'll see, right? We don't know, but that could really be a spark to kick us into like 6150 or 6200 in the SPX. And if they fail to do it, man, that could be the excuse that drops us back down into like the 20 period daily moving average, so below 6,000. We're not looking to crash and burn, right? Just more disappointment than anything else. The AMD, I'm not bearish on it. I know I said it's a bearish trade, and short term it is because I'm targeting that 125, but not because I'm overly bearish on this. I'm mainly going for a short because it flew too close to the sun. So it got a little outstretched, it moved a little too far, too fast, and I'm looking for some mean reversion. Now, if you look at the last mean reversion that we had here, this little bit of a pullback, it's not much, right? We're talking like 15, $20 at the most. And that's all I want. Just a little something, something, call it good. And I'm going to dump out and, go on to the next one. So if we measure that, it's 130. I went with 125. It lines up with the 200 period daily moving average, which was, when I was thinking, well, how far are we going to pull back or what are we going to pull back to? We still have this, it's flattening out, but it's not flat yet. We got this down sloping 200 period moving average. And I thought, well, in a nice pullback, that'd be a good target. Plus, look at the previous pullback that I just measured to the 20. Yeah. And then the 20. Yeah. And the 20. Yeah. So if we pull back to the 20, yeah, it's at 125. You like it. For $22, I mean, that's my max risk, right? If it doesn't work, and I don't have to lose the full $22 either. If this isn't working out, I can just close the trade and move on. It's maybe I'll lose half or a little bit more. But you can't get coffee at Starbucks nowadays for less than $10, so yeah, what's the risk? Meta looked good, but I wasn't fast enough. I was messing with something else, and that short was fast. I don't know if any of you guys got that, but if you did, kudos for you. I missed it. Now look at it. So we're through yesterday's halfback, and right now we're giving it a dap from the other side. If we can't close above it, we're likely going to get back into that 702. Probably not today, right? But to continue the move to the downside. And what I'd really like is to retest that 20 period moving average. That'd be good. So the 20 period is 683 ish. We just do a little round in there. It's not that far off, but we are still above an upward sloping 200 period daily moving average, and we haven't seen the 50 since earnings, right? That way back here when we took it and ran. Earnings, uh, not too far out, right? Into July, almost August. And I don't see us getting back to the 50 without something really bad. Now, long term, like their next earnings might be bad. They're trying to sign up all these AI guys, and their sign-on bonus package is like $1 million plus. I don't know how many people they signed up, but you they've already got a capex like crazy. They're spending money hand over fist. And now they're going to go out and hire a bunch of engineers with $1 million sign-on bonuses. I don't know what the investors are going to say about that when they look at how much Facebook made versus how much they spent. It's not like Apple. I've seen Meta come in and say we made 21% above and beyond, and they just tanked it, crashed and burned. And in the same earnings period, Apple was like, we made 7%, and it shot off like a rocket to the upside. So, you know, they're not treated fairly or equally. But for right now, we had that breakout, gap up breakout yesterday, and we had a very small gap up this morning, completely outside of yesterday's range, and then the rope to dupe, right? Went up a little bit more and then down we went. So if we can close the gap, that would be a nice short-term trade. And depending on how fast we do that, that would be like a 10 period daily moving average retest or a $700 strike. Not really thinking that this is going to, like crash and burn in the long term. Not yet. I think we got to get to earnings and get that investor disappointment and then maybe test the 50 period moving average. So out of curiosity, what would a short look like on here? I don't really want to even price a short now because we've already fallen so well, right? That's a $10 move today. More than that actually, but we've started to run back up a little bit. It would be better to price a long after falling this far rather than doing it the other way around, but we'll look anyways. Why not? You guys got a stock or a market you want to look at? I'm interested. Throw it my way. We'll take a look at it. I guess we'll just look at where's liquidity at on this thing right now. Bump that down to 20. We'll just look at the volume column. Start on the put side. Yeah, it's probably a bit fast in the stream, but it's just the quickest way to do it. And then look at the call side, same spot. Look at the volume. It's basically where I put my mouse. We're not expecting the volume to be anywhere except in the front, but if you don't look, then you don't know, right? And I don't want to make an assumption. Ooh, 750 strike got a little bit of volume today. That's for July 18, next expiration, which is what I used today for both of my trades. Not really out of choice. It's where the liquidity is at right now. And I had an argument with someone, not really arguing, but we had a conversation about that earlier today. They wanted to take a trade on the 11 expiration in a different product. Maybe it was AMD, but there's just no liquidity there. They're like, oh well, I'll get a better price. Not really. Not if the bid ask is so wide that you fall through the gap and you got to pay for it, and there's no liquidity and you can't get filled and give up a bunch of money to get filled, and then you're stuck in it and you can't get out. No thanks, right? I'd rather just get a better trade somewhere else. So Meta, um, 4,600 on the 750 strike for today. For all we know, they're liquidating that call position. We don't know for sure, right? Because there's a lot here. And the same thing with the 700. And that's about institution size right there, anyways. A 700, 750 call spread. And now they're like, oh, it ain't working out. And they're starting to close it. Do I know that for sure? Nope. That's just a good starting point for, taking a look around and asking where are they positioning or what are they doing. Now that we found activity like that, of course, we can go into the time and sales and see how the transaction really went. Were they done at the same time? That would give us some clues. Did they hit the bid or hit the ask? That would help. So this is just pointing us in the right direction, right? It's not giving us all the answers. And of course, some volume in the front or the next expiry out, thousands here. And then, oh, yeah, that's new, right? 715 calls, 16,000 contracts came in today. And we know it's new because they only had 5,000 open when the day began. So if they closed those five, we would have seen, a volume of around 5,000. But it's three times the amount of volume that was already here. So let's take a look at that. And it's an odd, no, wait, I slipped my mouse there. It's not the odd one. I was going to say it's the 717 and a half, but it's not. It's the 715. So let's take a look at the 715 calls, see what they're doing with it. $7.15, right there. And we don't want spreads. Funny enough, if we turn off the spreads, then we don't get anything. So that tells us right there that the position that we're looking at is part of a spread. Very likely that they rolled it in. So we'll undo conditions and see what the spread was. Well, I'm not seeing the thousands and thousands that they had there. $16,900 contracts traded. Hmm. So I unchecked the series. So I've got a bit of a hunch that this might have been part of a multiple expiration trade, like a calendar kind of trade, and that it wasn't showing up for that reason, but it's still not showing up. I don't, sometimes, man, think or swim. Let's look at it on another broker. Meta, June 27, 715 strike volume. Sure enough, 16,900 contracts. I mean, in theory, they could have done it 20 at a time or 10 at a time. You know what I mean? It doesn't have to have been in large size, but that would have been a lot of sweeps. It should have triggered a lot of notifications through the day today. So in the Discord, you could probably, let's come back over here. something like tradie ticks, sweeps. Those are news articles. Mm-mm. All right. Well, there was 20,000 contracts traded on the 715 strikes. We just got to adjust the to the call side, and then for this expiration. 16,000, that's not the number. Well, the way they lay it on, it hit all at once. That's the one, 16,489 with an open interest of 5. That's the one we were looking at. They filled in the mid around 531. You imagine paying $5 a contract and getting 16,500 contracts? Somebody ponied up some money. Try this. If you're still hanging out watching the stream, \C and then use a time frame. So like CD, C3, right? So \CD and then put your ticker in there. So we'll say Meta, and that'll give me a daily chart. Yeah. Now, if I wanted something like an intraday chart, \C 3 minutes, like that. So opening the menu with the \, shows you what you can choose from. Then you can pick your product here on the side. I want to use this one. If I want charts, maybe something else. Right, but I like using this one. So now I can just pick what I want. Here's chart. So now it's asking for the symbol, Meta. And it says I have 4 more choices if I want to use them. So I can just hit the tab sign. Now it's going to ask, hey, what time frame you want? 5 minute. Now I can hit tab again, maybe. Yeah, I messed it up. Time frame, 15 minutes. Chart type. Let's go with a candle. You want some moving averages? Sure, why not? Or indicators. How about an RSI? And if I didn't break it, there we go. 15-minute with the RSI candle. We didn't see all my moving averages because there's not very many candles to show that moving average, but there was the start of it right there. Well, those options that came in today of size, they were all done in these 50 lots, it looks like. We really didn't get one big massive chunk. It's smart, I guess. It's just really odd to get that much trading activity in such a short term expiration in a new position like that. I mean, they can do it, don't get me wrong. It's just, it's not normal. And they were hitting on the mid, so it doesn't give us any clues towards whether they were buying it or selling it. Oh well, so it goes. The front end can be janky anyways. You got to be cautious with it. So airlines got whacked a bit today. They were showing up in the scanner. And Chinese names were getting whacked. DoorDash with a really nice stretch. There's another trade we were talking about earlier today. Um, Palantir. This thing just keeps going and going and going, right? So we had talked about selling puts in this and then using the credit collected from the puts we sold to buy a call if we had another V bottom. I don't know if you guys have been watching this V bottom over the last few days, but it did it Monday and then it did it again Tuesday. And the idea was, hey, if we V bottom today, we'd already have the credit from the puts we had sold, and we could try to, like a short term call scalp back to like 147 today using like Friday expiration. But we never got the V bottom. So if you had the credit from the puts, you're still good because we were talking about selling a 135, 140 put spread. And that $5 wide trade was offering 225 in credit. July 18 expiration. It was the 140, 135. Oh yeah, that thing's already it already made money $40 or so, $35. So that wasn't bad. And if you didn't buy the call, you still had the credit left. And you could just save that credit until Palantir does make a move up. And if it doesn't make the move, well, then, you just keep the credit. This rejected on the 786 for the reversal. So he's thinking maybe retail today, right? Walmart was getting lit, Costco. Um, didn't see Target, but we didn't get anything, right? It just fell out, and still nothing really. Nice rounded reversal. If you talk about the textbook bull flag pattern that I always say is a bears the bull trap or a bear's game. Those bull flags are not good longs. They're good traps for longs. So Walmart, it made it to yesterday's low, bounced on a 786, and now it's broke that and it's trying to get into a 111. Earnings are out of the way. It's trying to hold that 10-week moving average. Long term as a swing, I like this back to 80. We got no reason to say that, but there's an old phrase that says if 100 then 80. And when we broke 100 way back here with this evening star reversal, really nice weekly chart pattern. That was the short signal down into this $80. If 80 then 100. So we did that, then we made it back to 100 because if 80 then 100. And now we're just fighting that 20 period moving average. Now, it's not support and resistance. You don't want to look at moving averages like that, not really. But it is a line in the sand. And they're putting in work on that 20. They're not going to keep doing that if they don't get their returns, right? Just think about you doing work out in the yard trying to, say, dig a hole or something. You're going to give it some good go at first, but, you know, blood, sweat, and tears, and a couple of days later, if you're still at it and you're not seeing any results, you're just going to give up like anybody else, right? They're going to give up on that 20. If it doesn't hold, they're very likely going to give up on that trade. So you can be the confirmation trader if you like. I'm not big on it myself, but to each their own. I'd like to get it off of these highs up here, which is what I thought we were going to get a chance to do today, but we didn't. So get a short off of the highs or let it break 95, which is basically the 20-day moving average, and then aim for this low. If we can break 92, then we can go to 88. I like it. So what's an $88 trade look like? Well, the bad thing is Walmart, you would expect it to have, really good options, and it does not have really good options. It's kind of trash right now. The open interest is interesting. It shows us where they are positioned, but they're doing it in like little bites because look at the volume, 80, 20, 12. But prices are cheap, you don't have to put a lot of risk into it. So an $88 put, an 88 strike put, let's say it the right way, would be yeah, $18. If you wanted to spread it out, you certainly could. They got a 50-cent wide position here for $2. $2. That's more, that's commission for a lot of people. So this trade right here, is risking $2 for a chance to make $48. I mean, that's pretty cheap risk, you know. The chances that it'll actually monetize, it's kind of low, to be sure. You know what? Why not? Why not? Let's see if we can fill. That is the July 18, 88, 87 half. And I'm going to try to fill for a penny because why not? And if I fill immediately, then you know you should just leave it alone. The open interest, oddly enough, is on the 87 and a half, right? Not on the round number, 88 or 87. In fact, there's not even an 87 left. No open interest, no trades on it. There's a bunch of bag holders out there. We might have to go to 90. That's $11. But it's $2.50 wide, right? So it's like $239 profit for $11 risk. It's not bad, but and it's wider, so it has a greater chance of actually making money. But I wanted that other one just because it was so cheap. Honestly, though, you could just straight up buy the put. I would like more time. We're talking about a short in Walmart. Walmart's not usually such a beast in the move, right? You can see how like back here, it just normally moves a lot slower. So these really big bars are kind of out of the norm. We could still do it though. So maybe we change time frames. The problem with changing time frames is there just won't be anybody home, right? See the volume NA, NA, NA. There's just nothing out here. And if you do get at the money to find some volume, now you got to really pay up, put $200 of risk on it. I like this short, but I don't like it $200 short. You know what I mean? Like, I don't think it's worth risking $200. And then as soon as you get into the out of the money calls, you're $5 wide on the strikes. Over here, you're at least $2.50 wide. This is a $100 company. You don't want $2.50 wide and $5 wide strikes on a, you know, $100 company. It just shows how illiquid it is. Oh, out. Y'all see Ion Q? Really nice H pattern, which generally would mean hell for shorts, but it's paying them shorts right now. So new low on the day, just breaking down, cutting below 39 and a half, and we've got 39 as the 111, and then 38 and 3/4 for the 1236. Now I like Ion Q, but I think they were doing like a stock offer or something. They're gonna get whacked doing something like that. Neutrinoless double beta decay. Yeah, okay. They got a double X now. Opened on the 24th. I'm still long in this from like November, so I'm good, but I don't think I want a new one yet. I'd look for a TRB setup if you're not in this yet. A TRB would be like something like that, crossover, get above 42 basically. And if you want to get risky, look for a bounce off that 20 period. So let's just price it. Why not? What's a call cost in this thing? Why are we looking at calls? Come on, you guys watch every week. It's not because we think it's going to go up, right? It's because you're better off buying calls when it's falling, price wise, than you are trying to buy puts when it's falling. You'll get a better price, right, for your calls. It doesn't mean you won't lose or that your chances of losing are going to go down. It's just that if you do lose, you're likely to lose less if you're wrong than if you had tried to go with the flow and you were wrong. So this is 50-cent wide trade out of the money for $22. And when we look at it and say, well, is it fair? If I built it at the money and they wanted half, that would be fair. But I'm out of the money and they want more. You see that? They want $25 for this and I'm out of the money. Let's go back to the other one. They want 21 for that one. So what's up? It's the implied volatility. Don't get confused with this because it's really easy. You got the bumper stickers, the t-shirts, all that stuff. Buy low, sell high, right? So with implied vol, you want to do the same thing. You want to buy the low implied vol and sell the high implied vol. If you don't, you get all out of whack. This isn't lining up for us. Let's go a little further out, see if the price changes. It's 18 cents, 16. It's just that 40 half. It's really just that 40. It's climbing back up again. Look at the implied vol, how it goes from 85 down to 79, and then it climbs back up to 85 again. That's your skew, right? It's going like this. They say to look for the smile in the skew, but a lot of traders actually look for a smirk so that it's more of like, I know it's weird, but they're just trying to get a feel for the image. So drop down into product depth and turn on implied vol. Let's go to July. So I drew the smirk on the wrong side, but there's the smirk, right? When I drew it, I only had that half, whatever. So there's your smirk. If we had enough on this side, we'd have the full smile. And what we're trying to do is look at where price is. It's really close to this 40. We're climbing the upward side of this skew curve, right? And that's why our spreads are all out of whack with our pricing. This is a really good example of why we can't just read some little chicken scratch that says always do XYZ. They are ugly, absolutely, Nathan. I remember when I was new to options, I had this little checklist and it would say go this far out of the money, and then get X strike and this strike, and that's what your trade should be. But this is a really good example of why that would be a bad idea, right? If we start pricing these trades and we move it farther and farther out of the money, they're supposed to get cheaper as you go, right? Because your chances of actually having a profitable trade decrease the farther out you go. Less chance of having a winner, less money I should have to put up in risk. That's the way the market works. It's a very fair and balanced place. So if we're trying to price this trade and it's getting more expensive as we go, then we know that the options prices are out of whack and that we don't want to put that trade on. We just want to go find another trade, another expiration or something, right? That it's just not worth the risk to trade those options on that expiration. It's a bad trade. So what if we just take it out, like go out, January next year at the money to dollar wide, 35 cents. Nice. If that fills, that's really nice. When you build a trade at the money, it's supposed to be half the width of the spread. That's what fair value is. So this should cost $50. And right now they're willing to sell it to me. There it went to 50 right there. They were willing to sell it to me for 35 cents. 33 cents really. There it is, 38. So if you could get caught in that and like get filled for 30 cents, 28 cents, kind of work the order, jiggle it around, think of going fishing, right? You toss the lure out there, you don't just reel the sucker back in again, right? You bob it around and, you know, try to lure the fish. Same thing here. Put a price on, work the order, try to get someone to nibble at it. If you don't get filled, then you can give up another penny or two, work the order. Same technique. And I've done it, you know, where you try to target new traders. I know it's not fair, but I'm trying to make money. You know what I mean? I don't care about somebody I've never met. So if I can put some crazy stupid price on there and get filled, oh, I'll do it. And every once in a while, you actually do get filled. So, take something like this and just put some silly price on it, like 10 cents. That is not supposed to fill, right? Like, that's robbing somebody. But hey, if they'll give it to me, I'll take it, right? Because in like 10 minutes later, you just turn right around and sell that back to the market for 50 cents and you made 40 bucks. Now your chances of actually getting that done on a just random name like this, very likely not going to happen. But wait for one of those short days when GME is popping and AMC and everybody's coming out of the woodwork on those. You can get that sort of stuff done just because people don't know any better and are willing to pay stupid prices. So IonQ is a part of that whole quantum space. I like this name. All of them are suffering, so it's not IonQ. A lot of these guys started to dilute their shares, and they all got whacked. Long term, I think they still have something, but the space is not hot right now. So you're going against the price. You have no momentum, no trend, no pattern, no setup, no news, no trigger. No thanks. Now on the intraday, if you're just chasing it, you got that 111 coming up. It works on futures just as much as it does on stock. So let me get that on the close. How I would normally do it. Like that, yeah. Roblox. These guys were in the news, weren't they? Oh, yeah, no. It was just that. That is a very pretty chart. Look at those moving averages fanned out like that. It's really pretty. This is the heat map for the day. If we're shopping around trying to find something, this is a really good place to start. I don't know if you guys have ever really given these a fair shake. When I was new, someone showed me this. I thought, what a complete waste of time, right? I didn't know any better. I just looked at it and I was like, what are you going to do with this? This is completely worthless. But it's not. If you're trying to look at 100 shares or 100 companies, which is what we're looking at right here, is 101 companies, and you're just trying to get a feel on the day of like what sector, what industry, what space is hot, which ones are not hot, what's getting burned, it's a really good place to start. Sure, I'm not going to trade because of this, but it can point me in the right direction. Should I be looking at phone companies, cloud computing, banks? We can see the financials down here, right? Some financials are red, some are green, so that piques my curiosity a little bit. Which ones are getting whacked? Credit cards, lending institutions, regional banks, energy, same thing. It's split, or utilities, real estate, staples. All of those are, the value companies instead of growth. Look at consumer discretionary. No wonder we're not rallying today. That's getting whacked. Oddly enough, McDonald's is down with Amazon, but Home Depot and Lowe's are doing good, right? So it's a really good starting place. If I'm shopping around, I want to know where I need to be shopping at, or at least what direction should I look in. Sure, you could use watch lists, right? But then you're squinting at a bunch of tiny letters. And this, I don't know, I just think it's easier to see. Plus, you can zoom in, and see into the sector or into the industry better. So, if I want to look at financials, there's financials. You can do that with your own watch list, by the way. And if you don't know what sector the names are in your watch list, put your watch list together and then bring it up in the heat map, and it will sort your watch list by its sector, which is really nice because new traders don't necessarily know what names belong to what sector. You might not have an idea of what all the names are in your watch list. I have to get a social media post out, so give me a second to take a picture of this. All right, that was easy. Done and done, right? So while we're on the visualize tab, if you haven't seen this yet, this is the index watch. You can put whatever index you want in there, basically whatever watch list you want. So if you've got a watch list of the Mag 7, for an example, I thought I had a watch list of the Mag 7. I thought, wait. So you can bring up your watch list and see how much volume your list is getting and then how much capital flow you're getting. Now, what I like to do is look at how many are advancing versus how many are declining, and then compare that to the money flow. Today we've got 5 and 5, right? It's a split market, and you can see the names that I have here. The one that's down the most is Tesla. It was down almost 6%, it looks like. and the one that's up the most is Nvidia. That makes sense. That's usually how it goes. But with Nvidia up this much, I would have expected the S&P and the Nasdaq to be up a little better. Off of the high is Google and Broadcom, really off their highs. But then you can put in your traditional sectors. So here's the S&P 100 index. And again, we've got the advanced decline. So 66% of the S&P 100 is declining, but more money is coming into the market than going out of the market. There's some divergence right there. If more names are going down than up, we should have more money going out than in, and we don't. So there's our divergence. A lot of times we can't actualize that this late in the day, but earlier in the day, that would have told us to be careful on trying to take shorts, heavy shorts, right? There's nothing wrong with getting like some scalps or intraday plays, but we wouldn't have wanted to load the boat short because this is telling us, be careful with that. And then, you can get an outlier like NVIDIA. It's a very expensive product. And if it's doing really good with one other name, AMD, then the money from those two can cover a lot of negative companies if they're not very negative on the day, right? And that's where you get your discrepancy. And these are detachable, by the way, so you can break them loose and stack them up because they make these little bitty windows. So then you can put the S&P in there, the Nasdaq in there, and you just keep loading them up, right? See how tiny of a window that is? Now I want the volume to be on the other side of the capital like that. But you can make them into tiny little windows and then stack them, and you can have the S&P, the Nasdaq, the NYSE, your own index, and the Mag 7, and you've got your finger on the pulse of everything moving for your market breadth. I already had the Nasdaq, fool. Try the other one. So there you go, right? You just stack them up and keep your eye on what's happening out there. The S&P is divergent too. It's not just the Nasdaq. That way, if you want to run alpha protocols on a day like this, you would want to see 95 or 97, 98 names all doing the same thing. Oh man. So Roblox is getting hit. Oh, well, that makes sense. Jim Cramer called it for a long yesterday. Now it's bleeding out. From a buy low, sell high perspective, buying it on this 4 period has worked out really well. And if you don't want to do that, buying it on the 10, which right now would be buying it at $100. I know nobody wants to buy it at all-time highs, but it's not a bad play at this point. What else got? Spotify. 840 price target from Guggenheim. Short term, short into the 10 at most. Netflix, Same thing. This is a really nice scoop pattern. If you guys don't recognize that, um, scoop isn't really in the candle pattern textbook, but let's see if we have it on a weekly. No, not really. A weekly scoop is a really great pattern, right? It's kind of like a cup, but cups have more rules, and scoops don't have as many rules. In fact, the scoop pattern that I'm looking for on a weekly is this, but I'm on a daily, right? So this doesn't count. But you would want this kind of shape on a weekly. That's a really nice weekly pattern. If you find it on a daily, it's okay, or an hourly if you're really short term trading, say using Friday's expiration or something, next Friday, you can do it on a shorter term. But man, on a weekly for a swing trade, it's a really good play. You see that gap up right there? That's telling me not to short Netflix. Doesn't matter that it's pulling back now. That weekly, shoot, I'm still on the daily. All right, that daily gap up, it's not bad now that I see it. It's daily. I don't love it as much. If that was a weekly gap, oh man, we'd take that. So we had a gap here and we covered it, stalled. See these two solid days as a part of that stall, and then it just took off. But trying to read out all the wicks, they had a lot of pressure that they were working through. It was all these guys. Those guys were trying to protect their position. So they had a lot of pressure here. And then they came in with force and just drove that sucker right up into a breakout. So it's a lot of buying pressure. The problem is, look at the cost of this thing, $1,300 a share. They really need to split the stock on this. And they're calling for a golden cross. Oh my goodness. You know that's part of the sell off right there. Every time. So it doesn't mean it's going to stick, but when you see this golden cross, it's nearly always a short term short because you've got your counter trend traders that just pounce on it immediately. Longer term, sure, yeah, it turns into a continuation long, but Netflix, Meta, Microsoft. We had Microsoft long already. It's glad to see that everybody else finally got on board. Better late than never, I suppose. Microsoft was the bullish beast from the last earnings. It look at it, it never slowed down. Two trips to the 10 immediately just got right back above. It's really nice. So we're getting into that $500 range, and if you're looking for a short, this is a hard one to short because it's still not stopping, but it's very likely going to run into earnings, and then it's going to drop. Right? Um, we call it pulling forward earnings. So if they are pulling forward the earnings in this, then a big round options level is very likely where it's going to stall out. I've got 496 marked with the fib, which I believe is from a monthly. Yeah. So that's really big. You could tighten that up, use like the weekly, doing it that way. And we're at the 1236 if we did it with the weekly. So that's a bit of a concern, but it's still that $500 level. What's a $500 short? We don't want January. All right, hang tight. We're going to watch volume. Just look at where my mouse is sitting. It's this is volume. right? So just look in that area, and we're looking for volume because you got to get used to going fast, right? Especially when you're on the hunt. So we got August has got some decent volume today. And Zoom has drawing tools. So if you wanted to do this on your own and you don't have your drawing tools like I do, I use this Epic toolbar. But if you don't have that, turn your zoom on and then draw your bar over your volume like that, and then just get used to spinning the wheel. Then the other side, I just run it back the other way. So August looked like as far as we could go in Microsoft before we ran out of volume. There's a little bit of January today, but I mean that's too far. I don't really want to go that far. Some in the monies for August, not helpful. Lines up with the well, not perfectly. I thought maybe it was both sides. It could be a strangle or a straddle. It would line up for earnings. All right, let's price a $500 strike. Call spread for earnings. The end of July. So we don't want to use. Well, we'll price it, but I don't think we want July's options. We're likely to get tested with this. It's $5 wide, out of the money, $1.65. So risking 335 for a chance to make 165. All right, so if you're wondering why I just brought over the other broker, one, this is the one I trade on, but two, it has this P50 value, and it's the only broker I know that has that. POP is probability of profit. All the brokers have that, and if it doesn't, just use your delta value. But that just means profitable by at least 1 penny at expiration. Well, most of us don't trade these things to expiration, right? We hold them for a while and make some money and we get out. So this other one, P50, is what's the chances that this particular trade could hit at least 50% profit between now and expiration? Well, that's a much more valuable number because one, I like hitting 50% profit and getting out. And two, it's between now and expiration, which means I don't have to hold it all the way to expiration. And our chances of hitting at least 50% profit in this trade before expiration, 75%. It's bouncing at 70, 75. Still, it's in the 70s. That's not bad. We're still risking, 330 for a chance to make 160. Yes, we didn't change the risk here, but we have a better idea of our chances of being profitable. Another thing that we can easily see here, we could have calculated it on Thinkorswim, but this orange bar, that's our expected move model up here, the implied volatility average range model. And it's showing us that we're building our position on the edge of the range model because that's where the orange ends. So if we were trying to line it up with the implied volatility average expected move model, we're there. If we wanted to do one standard deviation instead, that's that blue dotted line. Two standard deviation is this blue dotted line. So what do they give me if I dance it out a little bit? $1.14. If we widen it out $10 wide, because look at the volume. Skip that 510, it doesn't really have any juice there. The reason it doesn't have any juice is they're already in it. They're at 25K in that one, so they're not really trading it heavy. These other two are only at, well, they're less than 5, and so they're getting more trades today. So this is now a $10 wide trade, $1.86. That is dangerous, right? Because now we're risking $800 for a chance to make $200. That's a bad trade. I don't like it. I don't want that kind of risk for this little bit of a reward. Here's $15 wide, but it's only 50 cents. I'm just looking at volume, right? Trying to see what we can find out here, shopping around. So if we're thinking that it's going to stall out into earnings, maybe a butterfly would be better, and it'd certainly be cheaper. Yeah, this is my concern, that we run up, and this is I should have marked a different one, that we run up and we dump right before earnings, like this one. We ran up sideways, dumped at earnings. So we got the run. Now are we going to hang out and go sideways and then dump? If we hang out and go sideways, like we did back here, that butterfly will be perfect. So price out a $500 butterfly either for July 18 or on the earnings. We could see earnings here, August, uh, July, August. Then we just have to find where they're trading. They don't have anything on August, so definitely not that one. I don't like it. I don't like it. Going back to July 18 expiration. Let's try a $500 butterfly. $0.60. So we'll just use some rounding factors here. Call it 50 cents. We're risking 50 to make 450. On butterflies, we never expect max profit. My max is usually half. So if it's 450, then cut that in half. It's 225. I would say, to be fair, cut that in half and just say it's like 110, 112. Are you willing to risk 60 to make 120? Yeah, it's 2 to 1, right? It has enough time in it that if you're wrong and it's been on here for a while, then you could probably roll it, adjust it, change it. So I like this. I'm gonna try to work the order here, dropping it down to I'm gonna start with 50 cents. And if I don't forget, then we'll revisit that. But let's talk about adjusting it once we get it on. So let me rebuild it here. Because sometimes just defending these trades are the only reason I'm willing to even put them on, right? Because if it's a binary trade of only winning and losing, I'm not so interested in it. So if we don't know how to adjust it, then that doesn't do us any good. So here's Microsoft. Let's get rid of all this stuff. There's the butterfly that I just built. And the idea would be, well, what if we put it on and it doesn't get to the 500? What can we do to fix this? Well, we could put a call credit spread on top of it using the same strikes. So we would want to sell the 500 and buy the 505. So let's add that. And we wouldn't get this much credit, right? Because time would have gone by. Um, maybe price went up or went down. if it had already fallen more from here and time went by, we would probably be lucky to even get a dollar, right? So let's handicap the trade and say we only get 90 cents for this $5 wide credit spread. But look at what it did to the trade, right? So it took our butterfly and it gave us what we call a ratioed fly. We call it a ratio fly because if you come back over here and you build a real butterfly, but you tell it that you want a ratioed fly or an unbalanced fly, the way Thinkorswim calls it, you can see that there's two 505s, three 500s, and one 495. Well, that's what this is, right? So if we turn those off, there's the same trade, but we would be legging into it. Right now, they're offering us that trade with a dollar credit. Like right now, you don't have to leg into it, you can just do it. But look at the risk over here, $393 for a chance to make basically 600. And if we don't even get to 500, we just stall out, maybe fall back down, you get to keep the $107 in credit. I mean, it sounds great, right? What's the risk? The risk is that Microsoft continues to run towards earnings and it overshoots our break even at 503 and just keeps on going and puts us into the negative $393 on the backside over here. That's the risk. Plus, it's 6 contracts, and that's a lot of bid and ask to spread around, and you might have a real hard time even just getting filled in this thing. Now that I look at it, though, I kind of like it. Can we make it any better before I put that on? Anybody got an idea? Like put the tent closer to the money or something? I'm open to suggestions. If you back it away, it's just going to increase your risk, probably. We can test it with this other one that I've already got sitting here. Yeah, see, it's much deeper. 467 now on that side, and only $33 if we don't get there in the first place. But we kicked it a little farther up the road, right? We were at 500, and now the midpoint is 505, and the overshoot is 508. So we gave ourselves another $5 buffer on the upside. But I don't like the trade because we really increased the risk. So you got to ask yourself, is that buffer worth the extra 100 and something dollars of risk that we just added? Sometimes the answer is yes, right? For sure. The butterfly, moving it to its new location, $57 if we just want a butterfly. It's got a lot of time and you could still leg into it later. There's nothing wrong with that, right? And if yeah, it's pricing at 113 now. So if we leg in later, probably get half that in credit. It's not good credit, right? It's $5 wide. We're talking like 60 cents maybe. But I mean, it'd be better than nothing, you know? That's my solution for fixing it in case something goes wrong. You can fix the other side too. If it overshoots our butterfly and it's up here somewhere, then you could put this um, call credit spread on from the other side, like a call debit spread instead, right? So you would sell the 505 and buy the 500. Then you'd have a call debit spread, and the whole trade would be put on for a debit rather than a credit. So it'd be like two of these, one of those. Yeah, now it's a debit, right? So just to show you what that looks like, turn that off. That's a great shape, right? If we was to overshoot. But now we're in the red and it has to make that move above that break even point or we lose. That's no bueno. So we would only want to do that trade, that adjustment, if it overshot our original butterfly. And if we're going to just put the whole thing on all at once, I like this one. So what's the rub, right? If we were going to put it on, what is the concern here other than the fact that it's got, all that loss? The thing you have to be concerned about is what about implied volatility? We know an earnings trade is going to get volatility crushed, and before we get to earnings, volatility is going to get artificially inflated. So we can jack the volatility up in the short term, start just getting it all out of whack and see what happens to our trade. Watch that yellow line. It's hurting our position. So every day that goes by, if the volatility was continuing to increase, but price wasn't going anywhere, this trade is losing more and more and more money. Now, we already know at expiration, as long as we didn't exceed that line, we wouldn't lose. But you know what's happening here? We can't get out of the trade unless time goes by because volatility fell. So I only moved volatility. Let's move time now. And we're going to get closer to expiration. Now you can see that yellow line is moving up as I go through time. That's what would happen to us. We would get stuck in there and we'd say, well, it's going to be a winner as long as we don't break this line. So I guess I can stay in it, but we're getting closer and closer to earnings and we're going to have an FOMC event, Jackson Hole's coming up. Like there's a lot of reasons we don't want to just get stuck in a trade, and we would be stuck waiting for time to pass just to get out of this darn thing, hoping that we didn't get run over in the meantime. So we can take that route, and that's if volatility was to go up. If volatility didn't go up and instead went down, well, that would help our position. We would start making our max profit sooner. We can't get more than max profit, but let's put it back to today's date and continue to drop the volatility out of the market, which makes sense because if Microsoft continues to run, volatility would continue to fade. We would not get stuck in the trade. As time went by, that would help us seek profit faster. And as volatility fell, we could seek profit faster. So that's a win win. So a rising volatility would hurt our position. That's what we would not want. And falling vol would help as time went by. So at least we know. I kind of like this trade. It's a little bit heavy on the risk side for smaller accounts, and you might just be better off just, straight up doing a butterfly. But if you do, it's 50 something dollars, and there's room to uh, adjust this later. Yeah, I already showed you what to do. Just add the call spread as a sell or as a buy later on. I think I can get that filled for 50 cents. I would like it wider, but what are you going to do? All right, so I'm working the order for 50 cents just to show you guys what I'm working with here. 500 strike, $5 wide, butterfly, and I'm trying to get filled at 50 cents. If you're not familiar with my broker, it doesn't offer paper, right? Like they just don't offer it. As a trial, they do in the first 7 days, and then that's it. You don't get it anymore. So you don't have to worry about is that live? Yes, it's all they have is live. And I'm not telling you to trade it. I'm just telling you what I did if you care to join me, help yourself. I'm putting my money on it, or I'm trying to put my money on it. We don't normally, but we can. Yeah. You do them off? No, I don't do them every day, but I know a lot of people do. To me, I just want to do them when I see an opportunity, right? The idea that you can do a 0 day every single day just because they are there to trade. I mean, I think we all went through the hype when they first offered them as every days because they're kind of new, right? We didn't used to have every days every day. Um, Even 5 years ago, we had 3 expirations a week. We didn't have uh, 5 expirations. Lucian just hit me up, so let me answer his question, and then I will look to see. Yep. All right. Okay. So for 0 day, there's a little bit of a trick that I like in the current market backdrop, and that's put it on today before the close for tomorrow's 0 day. It's not technically a 0 day, right? Because you're supposed to put the 0 day on the day of expiration. That's why they're called 0 days because they have no expirations left. But if you are using small accounts and you're worried about PDT, if you put it on today and you close it tomorrow, you don't have PDT. So, it's a little trick to get around that. Also, because it's an index option, if you open it as a 0 day and you don't close it, it's not a round trip, it's not a PDT. So you can get in today and then just leave it on and don't close it. It doesn't, it's not a 0 day trade. But what if it's losing, right? Then you're going to want to close it. And then now you've burned a PDT. So I don't like to just approach every single day as, hey, I've got 0 day options. I guess I'm going to go here and trade something every single day. It's just a bad idea to me. And then I like to split the day into 2 parts. Do a morning 0 day trade or an afternoon 0 day trade, or heck, you do one of each. But I don't want to put one on first thing in the morning and expect to run it all day long. And I never like putting them on in the middle of the day, like noon, lunch. Most of the losing 0 day trades I've ever had are ones that I put on during that lunch window between like 11 and 12:30. So I wait to get out of lunch to put on the afternoon trade, and preferably I like to get out of that 9:30 to 10 a.m. window before I put on the morning trade. The reason for that is I have a phrase that says if we haven't broke out by 10 a.m., we very likely won't break out until after lunch, right? And that's handy to know because that's where you can get one of your 0 days for the first half of the day. So take Tuesday for an example. We opened gapped up and we ran just a little bit higher. That set our high at 9:45. And then when we fell down, it looked like we were going to break out, right? But what's the phrase? If we haven't broke out by 10 a.m., we ain't gonna until after lunch. Now, there's a caveat to that. News can break us out and it doesn't care about time. So we broke out here and the breakout failed and we came back in and we were stalled until after lunch. It works a lot. I know it may not be readily apparent, but my phrase, I made it up. It doesn't sound good when I say that, but I made it up. I have validated it. I trust it. I use it constantly, and it works. So by 10 a.m., if we're still in a range bound market, it hasn't broke out, it won't until at least lunch, and then you can start your 0 day trade. So you could have done your at the money call credits, put credit spread down here using something like a 60-60, 60-55 spread. That wouldn't have been technically in the money, but it would have been at the money, near the money, because you would have had to have been fast to catch that at those lows. If you filled it when it was all the way up here, then you would have wanted to get closer, right? 65, 60 would have been a perfect fill after that closed and the next bar opened. So that'd have been a good credit spread. The SPX doesn't give you fair price when you build it at the mid. $5 wide like this, you'd be lucky to get like $1.70-ish. But there you go, right? So you start the spread there and you look to see where we're at after lunch. Now, I don't like running them all day. If they give it to me all day, I'll take it. But my expectation is that I'm going to get it and that I'm probably going to get out around 11-ish. If you look at what happened by 11 o'clock, we were testing the high and we broke out of it. So there's your line in the sand. Do I keep it? Yeah, why not? Keep it unless or until that level breaks. And since that level never broke, once we broke out even higher than that, you can consider rolling this up on the day. They'll give you more credit for it. Don't do that if you're PDT limited, though, right? So take that, roll it up, and get another 60 cents or so, maybe. Depends on how much rate of change you're getting. So you can move that position up, or even just part of the position. Just grab the short leg, for an example, and roll that up. Make it wider without actually moving the other end of it. So you get a lot of play there. If we had rounded reversal and started to fall back down, say on this first breakout, then you would have put another one on up there, trying to get filled for near the money, at the money. This closed at 80, so we would have wanted to be at like 82, 87 right there. Now you have one on of each. So those 0-day plays, especially if you can move them or add to them, great. But if you're in a small account and PDT is an issue, try to get in the things the day before if you can to help you with the PDT, and use percentages more. So outliers are really handy. If you think we're going to be sideways tomorrow, use a round number and just like buy a butterfly tomorrow at 6,100, or buy a butterfly tomorrow for 60.50. You'd be surprised at how cheap those are. So we've got 15 minutes, which reminds me, bump Microsoft real quick. Replace order. It's trading at 58. I don't know if I want it for 58. I'll try 55. All right, that's Microsoft. So SPX tomorrow, butterfly at 6,100, just to see what it's pricing at. $20. I ain't paying $20 for that. It's a $5 wide options trade on the SPX. You cannot fill cheaper than 5 pennies. That's just the way it is, right? It's a nickel increment option strike. So the cheapest you can get this trade is $5. Put the order in for $5. You know what I mean? Like don't pay up, and stick to the round numbers. 61, 61.25. You can try to do cog lines, but since they're on 92s, 32s, and 11s, they makes it kind of tricky, right? So $5 wide here didn't work. Let's try at 61.25. Yeah, see, 20 cents. It's such a sideways day with no bearishness, no bullishness. So look at the day. We have gone nowhere. It's a doji day. Both sides are out of whack. But if we were heavy bullish today, we could get really cheap butterfly puts. If we were really bearish today, we could get really cheap call butterfly trades, right? So on a doji day like this, they want quite a bit of money for tomorrow. Why not, right? Let's where are we at? 1690. Get wild with it. Butterfly all the way out at 61.50. Now it's $5. I ain't paying $5 to go that far out of the money. You can do it with SPY too. Same idea, right? It's just much cheaper. And these are pretty much set and forget. If you get the one for today for tomorrow, uh, there's just nothing there. All right, QQQ, basically a doji day. I know it doesn't seem like it because we did a lot of running around, but look at where we opened, where we closed yesterday and where we're going to close today. The rate of change between them is not even a quarter of a percent. So what if we go tomorrow and we don't do anything either? This price of 540 Ironfly. I haven't done one of those in a while. Wrong button. So sell the 540, buy the 541, and then sell the 540, buy the 539. It's an iron fly. It calls it an iron condor, but since the middle is the same strike, it's an iron fly. At least that's what I call it. It looks like a butterfly, right? Like that. Whoa. Get out of here, demon. That was weird. All right. So there's your butterfly using both sides. Iron fly. The risk is $10. If we stay in the line and we don't do anything, we decay, you get all the money. If we start to fade, whatever the max profit is, at that price when you close at expiration, that's what you get. This trade will start to lose if we exceed 541 or 539 by the end of the day and close outside of it with a risk of $10. It's not bad, right? But it's a very narrow window, which is why they're offering you so much money. They're offering you $90 of that credit because they're looking at that saying, "Yeah, right. You think the S&P is going to close in a doji tomorrow?" Yeah, that's what that trade says anyways. Eight minutes left, and that Microsoft trade did not fill. Right now, it's running at, whoa, $62. I'm not paying $62 for it. Should have just got it when it was at 53, but it was trying to fill for 50. Now it's at 60. I mean, it's good if you already bought it, but if you're like me and you didn't get it yet, you're not getting filled. I just saw 52, so it's bouncing around. I'll work the order again. Try it at 50. All right, I just priced the QQQ at 530 by tomorrow, and it's free. Well, they're not going to give it to us for free. So when you end up with a situation where it says free, widen it out. So now I'm $2 wide, and they want 2 pennies for it. You're risking $2 for a chance to make $198. I like that. Let's go a little wider still. $4. Okay. That's a really cheap butterfly. Yeah. Now this is based on us actually going down. So if we don't go down, this thing ain't going to make any money. I went the wrong way. There we go. $10 for this butterfly, but we're $4 wide. So from 534 to 526, this will make some money, and it's for tomorrow's trade. If you want to get it a little cheaper, just make it narrower. That's $5 wide. I've already got a QQQ um, butterfly on, so I'm not going to add this one. I showed you guys that earlier, right? It's this one for July, but this one that we're building is just for tomorrow. It's a 0-day butterfly, and you can pick it up for $4. If you think we're going to go up rather than down, then do that. But run the call side. Technically, you can do both. Was it 5:30? 5:27. 5:33. Try to fill it for $2. Pay more in commissions than we're risking in the trade. And now let's look at the other side, which, by the way, just to show you guys what I'm doing here, I put that on. I'm trying to work the order. Look at the strikes. This one's not bad. We got the open interest in the volume. This one's okay. We got the volume, but no open interest. And this one's okay. We got the volume, but no open interest. So they're putting new positions on right here. They've already got positions here and they're adding more to it. So strikes aren't bad, right? For the Qs. I'm not the only one looking short. Let's say it that way. But what about the other side? And 4 minutes left. This is the implied vol expected move range. That's the 1 standard deviation. There's the 2, and we're outside of the 2. So we're not just the only ones looking short. We're looking for outsized move short. What about calls? Not so much, right? If you look at the volume on the call side, they're running much closer to the money. Within the 1 standard deviation and 2 standard deviation, this is where they're putting in their work. And of course, closer to the money. Over here, they're outside the box, which makes sense. Generally speaking, when we're looking for risk, it's usually left side tail risk, not right side tail risk. So, how about a butterfly on the call side to match the butterfly on the put side? They still want $4 for it. I'm going to try 3. Clock's ticking. All right, so that's a penny. 3 pennies. I had to adjust the middle, or I would have started to get into the quiet stuff out here where there was just no money. But that didn't help. $9. It's a bit more than I want to spend on a 0-day. This is just a fluke, right? We don't have any trend, no momentum, no reason to believe we're going to get an upside breakout into these levels. So it's not worth $10 risk. I know you might be thinking, so what, dude? It's just $10. And you're not wrong, but you still want something momentum, trend, a signal, a pattern, not just, hey, how about we just put on some way out of the money option trade for no reason whatsoever and spend $10 on it. If you do that, you might as well go to the gas station and get some lottery tickets because those have no reason for you to win either and about the same chances of success. So if I'm going to put on a random out of the money trade for no apparent reason, I don't want to spend $10. 2, maybe 3, gas station lottery price. Why not? So this one uh, isn't even the right strikes. Hold on, something's way out of balance here. Oh, look at the numbers. That's why. 46, 47, 48, 49, 50, 55, 60. That's why the prices went silly. So we got to tuck it in. There's $2 and there's $2. and there's 10. All right, there's our 4. But now it's only $1 wide. This one was at least a few dollars wide. And they still want $4 for it. I'm not paying $4 for it. You guys give it to me cheaper, you can keep it. All right, I went completely out to where they were all 3 and $5 wide strike, and there's nothing here. There's no bid and ask on those as bag holder prices, but I did it anyways. Just see what happens. If I feel in the next 15 minutes, fine. So hopefully you guys got a better idea what we're talking about when it comes to the call wall, the put wall, having some resources for digging into that more through the Spot Gamma link, and do the same thing. If you're using Trady Ticks, Mentor Q, whatever product you can name, go to their website and check to see if they have a FAQ or a glossary or any kind of education. You'd be surprised at how much really good stuff you can get from doing that. Then for what we found for trade opportunities, the market's in some kind of hurry up and wait pattern, and it has nothing to do with Powell. So whatever they're waiting on, it ain't done yet. It could trigger tomorrow or later in the week, but we just don't have it. And it doesn't have to be bearish. Everything we're looking at so far is not pointing bearish. It's not pointing bullish, but it's not telling us to get short. At least not with size anyways. And that's what I got for you guys. Unless you got questions, we'll just wrap it up and call it a day. All right. Everybody, be careful, be safe. I'll see y'all in the morning.